In this lecture, I want to show you something that is exactly the opposite of what we saw in the previous lecture. In the previous lecture, we saw a way to pick up stock at prices that are very attractive, at prices that are perfectly acceptable to you, and you wanted to hold Apple for the long term. And I'm using Apple as an example for all the course material, not because I like it. Well, I do like this, the stock. I do like to trade Apple, but it just makes it simpler for you to understand, and the concept can be applied to any other stock or any other ETF in the market. So in this example, what we are going to see is the opposite, is somewhat the opposite. Let's say you already bought Apple. So you already own 100 shares of Apple. And you bought it perhaps at $400 or $425, whatever the case might be. You're seeing a little bit of a profit. And you want to cash in, you want to sell Apple at a price that is acceptable to you. So this is just exactly the opposite. In the previous example, we wanted to pick up the stock. In this example, we already own the stock and we wanted to sell it at a price that was perfectly acceptable to you. And if that price, if you did not get that price, then you're going to pick up income in the meanwhile. So that's what this example is about. Let's take our same expiry series. Let's say we have 28 days to expiry in the March, and you already own 100 shares of Apple. So this time we're going to look at the calls section. So now Apple's trading at 466, and let's say a perfectly acceptable price to sell Apple and book your profits was, let's say, $500. You wanted to sell it at $500 and nothing less. So what you would do is you would come here and you would want to sell a call option at the strike price of 500. Now again, I'm going to move this to one contract. That's because you own 100 shares and one contract is equivalent to 100 shares. So when you sell one contract of the 500 call, you're going to pick up $4.15 premium right away. So this amount, 100 into $4.15 is 415. You're going to pick up this amount right away. And if Apple hits the strike price of 500, then let's look at the buyer and seller rights and obligations again. So if you were a call buyer, you would want the right to buy Apple at $4, at a price of 500, and you would have paid $4.15 for that call option. But you're the call seller. So you have an obligation to sell Apple at the price of 500, and you would have picked up $4.15. So this is what you would call a covered call strategy. A covered call strategy is an income strategy for stocks that you already own, because you're picking up this income. If you look at this income, $4.15 as a percentage of Apple, it's almost 1%. So in 1 month, you can make almost 1% on Apple by applying this covered call strategy. And what are your rights and obligations? Well, you don't have rights because you're a seller, so you have an obligation. You have an obligation to sell Apple at this price of 500 and nothing less. So that's what this contract means. And why would the buyer want to buy this 100 shares of Apple at 500? That's probably because Apple went above 500. Maybe it went to 510 or maybe it went to 520. So what's the negative for you? The negative for you is that anything over 500, if Apple goes over it, then you won't be in a position to capture that upside. But as it stands today, Apple is at 466, and you have the obligation to sell it at 500 and nothing less. So, both parties are coming out okay on this deal. And then you're also going to get this premium of $4.15. So you're really selling Apple at 504, which is a good almost $40 away from where Apple is trading right now. So let's look at the risk profile of this particular strategy. again, you'll see that you'll pick up 415. As long as Apple doesn't hit 500, you're going to pick up this $4.15, which is almost 1% on Apple. And if it goes above 500, you don't have to worry about this unlimited loss profile because you're going to sell it at 500. All you've done is you've given up any upside beyond 504. So 504 is the selling price for your option. And if Apple never comes near 500 in the next 28 days, you get to keep this $4.15. And then the next month, you can do something similar. So let's say Apple in the next 28 days went up to 490 and it expired at 490. You get to keep the $4.15 because this option is going to expire out of the money, and you get to keep that. And then the following month, because Apple is already at 490, then in the April series, what you would do is you would move your this call position to perhaps 530 or 540 or 550. So this way, you can continue to generate about 1% income on shares that you already own, with the understanding that if Apple does hit those strike prices, then you're going to have to sell your shares of stock at that strike price and nothing less. So it's actually a win-win situation. If you already own stocks, you can definitely use covered calls to produce monthly income on your stocks. So this is a great strategy if you already own stocks, and you can not only produce monthly income, but you also get to sell it at a price that is perfectly acceptable to you. So that is as far as this lecture is concerned. In the next lecture, I'm going to show you the hedging feature of options. So again, you're going to assume that you already own a certain number of shares. We'll take the same example. You're going to own 100 shares of Apple, but you're concerned that the price of Apple might fall down, and therefore you want to hedge your Apple stock position because you want to keep Apple stock for the long term, but in the short term, you're concerned about a price drop. So that's what we look at next. Thank you.